news breaking this morning already has economists kind of worrying about this month. Microsoft announced it will cut 9,000 jobs from its global workforce, the second round of mass layoffs there in just 2 months. Employment is one of a few key factors the Federal Reserve considers when deciding whether or not to cut interest rates. If tomorrow's jobs report number is weak, could we finally see the Fed say, you know what, it's time to cut interest rates this month? Joining me now in a Fox Business exclusive, Richmond Fed President and CEO Tom Barkin, coming to us from South Carolina today. President Barkin, welcome. You are a non-voter, at least this time around, but I really value your opinion because it's almost like you're a little freer to say what you think here. The ADP report this morning, which is considered a precursor to tomorrow's Labor Department report, didn't just miss, it whiffed, showing the economy lost 33,000 jobs. What does that tell you?
Well, the ATP report has not been all that highly correlated with the jobs report. So we'll see what comes out tomorrow. I think what's going to be hard for us to get our minds around is that we're probably going to have a softening numerator when it comes to the unemployment rate. We're also going to have a softening denominator as immigration slowed. And so, I'm going to focus mostly not on the jobs number, but on the unemployment rate. And we'll see what we learn about that tomorrow.
Okay. What if it does tick up 0.1% from the last time around? How do you interpret that?
Well, it's been in a 1 tick up percent range for about a year, a little more than that. We were at 4.3 for a while last August. We were down to 4.1. Now we're at 4.2. That all feels like a pretty stable range to me.
Sure. And we do know that the jobs market does look still quite solid. I get that. And the market is going to bet how the market wants to bet. The market is always asking for more candy and cookies and hot dogs like Joey Chestnut, but they don't want to eat the broccoli, which is rates where they are right now. That said, this morning, before the ADP number came out, the Fed funds futures, the mechanism by which people can bet on where rates will be, for the July meeting came in that the odds were 19% for a cut. But this afternoon, in the wake of that weaker than expected number, the July odds are now at 23.3% for a quarter-point cut. Do you think that the Fed will cut rates in July if there is a weak payrolls number tomorrow, a markedly weak payrolls number?
Well, I never try to predict the next meeting because a whole bunch of information comes in. We don't even know how many hot dogs Joey Chestnut's going to eat. So we've got a lot to learn between now and there, Liz. And we'll get a jobs report. We'll get an inflation report. We'll learn a lot more about policy. And, will we have tariffs? What will the tariff rates be in all these countries? We'll learn a lot more about the current tax bill. And so there's a ton more we're going to learn. And I think you just have to make the decision when you get there based on what you learn.
Fed Chair Jay Powell has been very, very pointed in saying that tariffs, and because we haven't seen more than one deal, and right now we haven't seen quite all the details with the deal that the president says has been struck with Vietnam now when it comes to tariffs, that still leaves a big question as to how tariffs might work themselves into rising prices. However, the Fed's been waiting something like 6 months for inflation to show itself. At what point does the waiting in this slightly restrictive stance that the Fed has with itself right now, at what point does that start to hurt the economy?
Well, the good news is that the numbers on the economy are very solid and have remained very solid. Unemployment is low, inflation is coming down, and core PDFP growth seems in a very good range. And so we haven't had the urgency of saying we've got an economy going the wrong way. We've got an economy going a very reasonable way. And that does make you ask the question how restrictive we actually are. Now, from a policy standpoint, I've been describing this as driving through fog, and I think that is what we're doing. You don't know what policy is going to be, and you don't know what the impact of policy is going to be on the economy. And so, so long as there's no urgency from the bigger environment, I think that one does what one does when you drive through fog, which is go slowly.
Yep, that's what you have said. You got to go through fog slowly. And right now, we don't have a clear picture, at least according to the FOMC. When you look at the 10-year yield, though, Tom, the 10-year yield, in a way, has been doing the Federal Reserve's work. It's been coming down even as rates have stayed at the pause level. At the start of the year, just around, I believe it was January 13th, I saw the yield was at 4.8% on the 10-year yield. Right now, it has dropped markedly to 4.29%. So does that make you guys feel a little more comfortable in staying at the pause level?
Well, the part you didn't show in the chart was the 3 months before that, where we started reducing rates and the 10-year yield went up. And so, again, if you took a longer term perspective, it's been about where it's been for a while. I'm not sure. I would say the 10-year yield is doing our workforce or isn't doing our workforce. I mean, it's reacting as based on its own set of issues, supply and demand for bonds, all that kind of stuff.
Actually, we're now stretching that out to a year, and we can see when
Like a year.
that 3 month, exactly, that we do see that. We get it. President Trump has been, capping off a string of insults at Fed Chair Jay Powell, and Jay Powell has remained solid in all of this and has not responded in any way, shape, or form. But come next May, we know that his term is up and that there will be a new Federal Reserve chair. Do you get the sense that amidst all of these insults that the president has lobbed at Jay Powell, that the next person who comes in, whether they believe that rates should remain on pause or not, will cut rates? And is that a bad thing or is that a good thing?
Well, I hope and expect that whoever the chair is will try to do the best thing for the economy. And we'll see what economy we have a year from now and whether the right answer in that environment is to raise rates, cut rates, or keep them the same. But I guess I just trust that whoever is the chair of this institution will do his best every day to do the best for the economy.
Do you get the sense if there isn't a cut in July, if we remain on pause, that September is a sure thing? Would you, if you were a voter, vote for September and see a cut?
Well, I learned you never exercise an option till you get there. So let's see what the economy looks like once we get to the July meeting, when we get to the September meeting, when we get to the meetings after that. And I could imagine a lot of scenarios that would be supportive of a cut and a lot of scenarios that wouldn't. I could even think of scenarios that'd be supportive of a hike. So we'll see where policy lands. We'll see what the impact of policy is on unemployment and inflation, and we'll try to make the best decision when we get there.
You talk to business leaders, CEOs all over your particular region as the Richmond Bank president. What are you hearing from them?
So the businesses are pulling back. They're on hold. They're on pause. They'd like to see policy settle. They see the fog that I've described. They're not cutting, but they're also not investing. And so what that means is low hiring, low firing. What that means is real constraints on investment. And they're waiting to see what happens. And we may get some more clarity relatively quickly. We may not, but that's what they're looking for, is they're just looking for clarity. They're also telling me that the consumer keeps spending. Now, it's not frothy on the consumer side, but what they're telling me is a solid consumer who's making choices, who's frustrated by high prices, and so is private label trading down, whether that's trading down by retailer or trading down beef to chicken or private label or whatever. But they're not backing off quite yet. And so that's what I see too, is a solid economy, not a strong, vibrant economy, but a solid economy, but one where people are not yet pulling back.
I do want to stress that if this deal that the president said has been struck today with Vietnam goes through, the tariff level would be at 20% for Vietnamese products coming into the United States. This, of course, would be paid by people who want those products, whether they are manufacturers stateside or the end user who is the consumer. Is that a level that you think that consumers could absorb, 20%?
Well, so it never quite flows that way through to consumers. As you say, there are people throughout the chain who end up absorbing it, whether it's manufacturers or retailers. There are also other choices one makes. And if the costs from one country go up 20%, but you've got supply coming from another country, then you might move to that other country, or you might not increase prices because of that. And I think we're going to see a very interesting situation where the manufacturers I talked to are just bound and determined to pass these costs on. But consumers are exhausted by high prices and making choices. And so I think there's going to be some amount of inflation coming out of it, but I also think there'll be some amount of pushback and customer resistance that will lead businesses to need to reevaluate their margins and their cost structure. And so I see risk on the inflation side. I see risk on the employment side. And I think we're just going to have to play it out, in part because we don't know this whole level of tariffs and we don't know how businesses are going to respond to it yet.
Well, you are hearing that they are determined to eventually pass the costs on that they see to the consumer. That's not a great message, certainly, that you're receiving, but it is what it is. Tom, thank you very much for joining us. I appreciate you coming on to talk about your perspective here as one of the Fed members. Thank you.
Great. Have a great fourth.
You
Thank
too.
you.
Thank you very much.